What's going on, guys? Hamilton here with the Trading Initiative. We're going to make a quick video on the business cycle. It's going to be super fun, but realistically, this is an incredibly important topic. We're going to dive in the business cycle, talk about some sector rotations, and then finish it off with one of the most prevalent intermarket analysis tools that we can utilize right now, because I'm sick and tired of reading all of the different bullshit narratives out there that a recession is around the corner. Listen, if this recession idea has been around the corner, please tell me why for the last 6 months it hasn't happened yet and the stock market has rallied. I'm not trying to sit here and say that a recession can't happen. Absolutely it can, and it will. It's just a matter of time. But for the people that are screaming bloody murder, doom and gloom, sucking people into buying shorter and medium-term puts that have just blown up and just wasted capital trying to catch the interim top before we capitulate into new lows, they've all been wrong. So what I want to do here is, instead of focus on opinions and how I feel and how you feel, and the price of eggs are expensive and people are losing their jobs and housing is expensive, like, just screw it all. What we're going to focus on is what every technical trader should be focused on, and that is price. So let's start off really quick by looking at the business cycle. So obviously, market oscillates up and down, and within those major market oscillations, what we've tried to do is break down the business cycle in terms of the market. And as you can see, there are 6 stages within this business cycle. The first 3, stage 1 through 3, are going to be during contractionary periods. The 4, 5, and 6, last 3, are going to be in expansionary periods. Very important to understand that stage 2 and stage 5 counteract each other, right? So stage 2, if you look at this and I ask you, what would be the #1 premier spot to be buying stocks and bonds? It would be stage 2, right here. And that is at the pico bottom of the contractionary period. What is the best time to sell those? The stage 5, the pico top of the expansionary period. It's incredibly hard to time those, but that's why we're looking at this. It's something I want you to focus on right now, is during stage 2. Right? If we actually read stage 2, it marks a bottom in the economy and the stock market. Even though economic conditions have stopped deteriorating, the economy is not in an expansion stage or actually growing, but stocks anticipate an expansion phase by bottoming before the contraction period ends. That's because the market is forward looking. Very important to understand that the market looks 6 to 12 months out, depending on who you want to argue with. It's not pricing stuff in absolutely right now. It's trying to look 6 to 12 months out and price that in, which is part of the reason why over the last 6 months, going back to October, we have seen price hit higher high in nearly every single stock, which we'll see in a second. Even though this recessionary stuff is looming, well, the market is saying we don't think it's as bad as what people on Fin Twitter screaming about right now. So as of right now, it's our job to figure out where are we within this, this business cycle. Where are we? Are we in stage 1, stage 2, stage 3, stage 4, stage 5, stage 6? Are we starting to see stocks and bonds pop up and commodities come down? Or are we somewhere on the expansionary side still, where we're seeing bond stocks and commodities drop down through the roof? Well, to be honest with you, if we look at the last 6 months, we're going to look at the value line geometric index, which is a summation of the average stock that's listed right now. You can see where we're at in terms of trend. The average stock bottomed out in October, just like the major market indexes, and since then we have hit higher highs and higher lows. I mean, that's not an opinion. This is fact. This is price, based off of charting. This is not my opinion. This is not my bias. The average stock has risen 16% off of those October lows. This is a higher high, higher low uptrend on a quarterly basis. We're going back to October. So it's not just a week. It's not a month. It's not even 2 months. This is a decent amount of time that stocks have been rallying now. It's very important to understand that. So right now, we're in an environment where at the very minimum, stocks are going up. You can spin it however you want. You can say that they're about to go down, whatever. The truth is, they haven't been. And it's not fair as a technical trader to say they have been coming down or they need to come down. No. We focus on what is happening. We focus on reality. We don't focus on fairy tales and what we want to happen, but what is happening. Last 6 months, stocks have been going up. So the very minimum, we have to be looking at the expansionary side. Now, we could be thinking, okay, the expansionary side, maybe we're transitioning from stage 1 to stage 2, which is still a lot of risk, and it's not necessarily the time to be buying as you can see illustrated here, we still potentially have some downside in stocks coming from stage 1 to stage 2. But in reality, commodities have been dropping too. U.S. oil is down 26%. Lots of different commodities are coming down year over year, specifically in the last 3 months. Some of them are still going up, but a lot of them are coming down. The one lagger here are bonds. They are technically in an ugly, you want to call this an uptrend, or at the very minimum popped off of those October lows, whatever. If you want to say this is consolidation, I agree with that too. It's definitely not a downtrend though. Bonds are struggling. So if we're talking about this stage 2 idea, which I think we're actually in, bonds have to start participating. And as of right now, yields are popping up. It's March 7th right now. And if you listen to the Jay Powell testimony, he really did a number on the market today, scared the market, yields popped up, the dollar popped up, equities got crushed, bonds actually held up decently well for the first time. But if the correlation holds of stocks down, bonds down, we could see bonds break down again tomorrow. But at the very minimum, this is not a downtrend since the October lows. We're still higher. This could be consolidation. You can try to argue this as a potential beginning of an uptrend, whatever. This is not a downtrend though. So I'm going to go ahead and go out on a limb and say we could be entering stage 2 right now. We're still in a contractionary period, right? Just like we said, the economic conditions have stopped deteriorating, but we're not in an expansionary stage. We're not there yet, right? We're not, hey, open the floodgates, go long on everything. There's still a lot of warning and a lot of bad stuff coming out in terms of data, and the Fed still needs to figure out exactly how high it wants to hike and how long it wants to hike, etc. But stocks are going up, bonds at the very minimum are not going down, and commodities are coming down. So from a business cycle standpoint, it's hard to argue that we're anywhere else in this. It really is. And that's not based off of opinion. That's based off of technical analysis. If you understand trends, which you should if you're focused on price, this should make sense. Let's move to the second thing really quick. Sector rotation. If we just glance at this model here, where we look at full recession, market bottom. Where's the market bottom? It's generally in the middle of the full recession. Once again, this shows that the market front runs the economy, right? We're in a full recession, but the market is already bottoming. The market generally tops prior to the economy topping. Remember, the market is forward looking. Look at the sectors that generally start to run the hardest off of the market bottom. Technology, discretionary, communication services, industrials, and then somewhat materials. These are offensive areas of the market. Technology, communications, and discretionary for sure, depending on where you're looking at industrials. That is an offensive area of the market as well, specifically that small cap industrial space. What has been up the most this year in 2023? What is leading right now in terms of sectors? I know it's tech. Tech is up, I believe, the most. It's consumer discretionary, which is lagging, but still up. If we actually use an equal weighted ETF, we see the RCD's up huge. So we take out Amazon and Tesla and we look at the broader base sector, RCD's up. We look at equal weighted communications. Let's just run with the equal weighted stuff. Equal weighted communications is up. These are up more than the defensive sectors. And then obviously, we just look at XLI. XLI is held up very well, actually closer to all-time highs than not. So industrials are up. Tech is up. Communications are up. Consumer discretionary is up. What is not up? Consumer staples. This is down. What is not up? Healthcare. This is down. What is, energy's holding up relatively well right now below their all-time highs, but it's not performing well this year. We're in a downtrend this year. Every other area of the market on the offensive side is in an uptrend. Energy's downtrend. Staples are downtrend. Healthcare is downtrend. Utilities, downtrend. Huge downtrend. We come back and look. These are late stage areas of the market that should be popping up. The beginning off of a market bottom are the offensive areas of the market, and that is what we are seeing through the first 3 months. So if we come back and think, okay, stage 2 potentially, right, coming out of a contractionary period, here's the lows here, where the economy, even though economic conditions have stopped deteriorating, it's not an expansionary stage. Bonds and stocks start to front run a potential upturn in the economic cycle. We go through sector rotation and we go, well, shit, at the bottom of the market, technology, discretionary, comm services, and industrial start to run before everything else. What is up the most? Tech, comm services, discretionary, and industrials. That is tick number 2, that this is not the beginning of a crazy bear market that we're going to drop to see new lows. This, by the way, what we're looking at right here has repeated throughout history, right? This is not like some random idea that the business cycle and sector rotations this time is going to match up. This has matched up in 2001 during the dot-com bubble, the burst, the GFC in 2008, etc. Go back even further. This stuff is historically accurate, right? Business cycle, stocks and bonds go up in stage 2. Sector rotation, offensive areas of the market go first. This is repetitive in terms of market cycles, and this is what we're starting to see in the beginning of 2023. Last thing I want to point out, and here's some more prevailing evidence here, that at the bottom, or at the top rather, you see energy and materials leading at market tops, and you see the offensive areas of the market lagging, consumer discretionary, technology, etc. And then you see at the beginning, the market bottom, what pops up? Consumer discretionary, technology, industrials, etc. This is historically, and by the way, check the dates. 2003, check the dates. 2006, 2007, like I said, this is not just for what we're going through right now. This has historically happened multiple times. The last thing I want to focus on is this intermarket relationship between consumer staples and consumer discretionary. So if we think about it, consumer discretionary is basically any company that you're going to go and you're going to spend money if you have extra money. Think Tesla, Amazon, other names within XLY, companies where if you have an excess of capital, you have a bunch of savings, you're going to go spend it. Think of like auto manufacturers, Ford, General Motors, just stuff like that. You have extra money, you're going to go and you're going to spend it. And then you think of XLP or consumer staples names. These are names where regardless of how much money you have, you're still going to spend. Think Walmart, think Costco, think Kroger, think Coca-Cola, stuff like this. Even in a full recession, you're still going to go to Walmart. And so what happens is investors during extreme downturns, they run and they flock to these sorts of areas because even though they might fall down, even though Walmart might come down, Walmart's not going to capitulate 50% like a high growth name will, right? So they find solace, they find defensive names, Walmart, Costco, Kroger, etc. They park their cash there, they collect dividends, and they kind of ride out the economic downturn. What we're seeing right now in terms of consumer discretionary against consumer staples, we're going to try to use the equal weighted stuff. So what is the equal weighted consumer staples? I do not remember. Let's go equal weight consumer staple RHS. So what we're going to do is we're going to go RCD, right? So this is your equal weighted consumer discretionary, and we're going to go RCD against RHS. And what is RHS? What is this going to do? And I already illustrated it. This is going to take a ratio essentially, right? We're going to look at the relative strength between both consumer discretionary and consumer staples in terms of equal weight, meaning everything that's within those ETFs is the exact same weighted amount. You're not going to get, right now, Tesla and Amazon constitute like 40% of consumer discretionary. Within RCD, it's not. They're both going to represent about 1%. All the other companies are going to also represent 1%. So we get a more fair judge of the overall sector, not necessarily the sector leaders and what they're doing. So what I want to focus on here, this is called a ratio chart. If you've never seen one of these, we're simply dividing the first by the second, and we're getting a ratio that essentially dictates relative strength for us in terms of trend. So when you type in RCD against RHS, up and to the right means consumer discretionary is in the lead. Down and to the right means consumer staples is in the lead. I want you to look at the dates here. In a bull market, you would expect consumer discretionary, right? The offensive area of the market, your Amazons, your Teslas, your Fords, etc. Companies that you want to go and blow money on when you have savings. That's where a lot of the growth is going to come. That's where investors and traders are going to be speculating the most. Those areas of the market have the most to gain. So when we divide RCD against RHS and we see from 2020, the market bottom, through essentially the beginning of 2022, which is when the market topped, we see consumer discretionary leading staples. That is a healthy bull market. That relationship is normal in a bull market. We see the topping out process where we can see the slope of the trend start to slow down. And then we see the eventual downturn. And what happened during the entirety of 2022? It was a shit show of a bear market. Consumer staples, all of a sudden, down and to the right, is leading during the market downturn. Exactly what we would expect. Investors and smart money flock to the safer companies, collect divs, Walmart, Costco, Kroger, etc. And they get out of things like Amazon and Tesla because those have the most to lose. We get a bottoming out process. And now what have we got since the beginning of the year? A pop back up, and we're over the 200-day moving average. Guys, consumer discretionary is leading. Consumer staples, this is once again indicative of a market upturn. It's indicative of a market upturn. You do not get consumer discretionary names outperforming consumer staple names if the market is afraid of a recession or new lows or whatever. And you can read through this if you want, right? Chartists can compare the performance of the two ratio charts, and you can see that this has stood the test of time as well, right? And by the way, consumer discretionary and consumer staples are not the only areas that you can use. You can utilize lots of different ideas here to come up with your own kind of market sentiment, but make sure that they're rooted in historical fact and not what your opinion or what you feel, right? Make sure that they actually pass like the scientific method, if you will. Make sure that it matters what you're looking at. So there's three things here that we just went through that pretty much paint an anti-bearish picture. And I'm not trying to sit here and impart my opinion on you. I want you to think about this stuff yourself. This stuff has repeated itself multiple times throughout history in terms of market action and where we're at. And one thing that's super important for us as technical traders is to be able to focus on facts and not fiction, not fairy tales, not what we want to happen, but what is happening right now. The fact of the matter is, if we look at SPY really quick, go back to the candlestick chart. The fact of the matter is the market bottomed where the green arrow is, October 13th. All of the major market indexes bottomed there. And buying puts and being short has been on the defensive side of the trade since October 13th. Everybody that has bought puts expecting new lows, SPY to take out that 360, 350 level, have pretty much gone broke. The loudest companies on FinTwit are screaming at you to buy puts, etc. Just take a step back, think about what the charts are telling you, and make the best logical decision that you can. Guys, I appreciate your time. If you're interested in stuff like this, we run a group specifically built for guys with 9-to-5s. This is how we trade. We take macro analysis like this, break it down in a top-down approach, and find individual stocks that we can trade. If you like this, the information is below in the description. Reach out to me, and I'll catch you in the next video.